Good morning. Today let us discuss about import finance. Import finance refers to financial assistance provided to importers. It helps in purchasing goods and services from foreign countries, offered mainly by banks and financial institutions, and also it ensures smooth international trade operations. So it's nothing but it is a funding provided to meet the cost of import goods and transportation and insurance expenses, customs duty and other charges. It reduces the financial burden on importers, enables timely payment to foreign exporters. So the objectives are it is to facilitate international trade and to provide a working capital for imports, to ensure timely settlement of import bills, to reduce payment risk for importers, to improve cash flow management. So overall, the objective is to protect the importers both in trade as well as the finance. So let us see the need for the import finance. Importers may lack sufficient immediate funds. Yeah, definitely, many importers they are lacking in money, so they are in need of money. Importers involve large payments in foreign currencies. Time gap between shipment and sale of goods, so it takes 60 days and sometimes it takes 180 days to maintain a business continuity, to enhance competitiveness in global market. So there are several types in import finance. The first one is letter of credit (LC). So we all know that LC is a major mode of payment which is used by the international trade and throughout the globe. And import loans, bill of exchange financing, trust receipts. So it is otherwise called as TR, and import advance, and finally buyer's credit. So there are few advantages. So it improves liquidity of importers, enables bulk purchasing, and also it reduces payment risk, facilitates smooth trade transactions, and enhances business growth. Parties involved in import finance. So the importer, exporter, and respective banks, importers bank as well as the exporters banks, shipping and insurance companies. So it is nothing but trade between the two parties and bank between the two countries, and also the intermediate shipping and insurance companies. They act as the intermediaries. Document used in import finance. Commercial invoice, we all know that is a primary document. Bill of lading or airway bill. So either if it is air and airway to sea, it differs. Letter of credit, this other known as LC, bill of exchange, and insurance policy and packing list. So the packing list is framed by the exporters. So insurance policies definitely nowadays it plays a very vital role. So they take this policy and they pay the premium so that it helps them in the future necessities. So letter of credit. So 80 to 90 percentage of the trade is done through letter of credit. So both the party are mutually understandable, and it acts as an acknowledgement between the two parties. So and also it has two times revocable as well as irrevocable. So revocable is nothing but without the knowledge of exporter, the other three party can cancel the LC. So whereas in irrevocable, this is not possible. So they can't able to cancel the LCs. So LC it is of the maximum time for LC is 180 days. So it is in 30 days, 60 and as well as 90, 1 to 150 and maximum is 180 days. Between the parties they agree for the days and they will be signing for an LC. If it is in 60 days, so in case if the Importer fails to give them a payment, and the bank takes care of the payment, so that for both the parties, so their commodity as well as their finance is much safer. Packing list is nothing but, so it is almost equal to the commercial invoice. All the data will be there in packing list. Whereas the only difference is in invoice you can see the price, whereas in packing list so you cannot see the price.